Okay, so now we are starting session 2, bank securities portfolios, trading and liquidity. We have 3 amazing papers. The first one, outages in sovereign bond markets, and I will have one of the authors here, Casper Helmuth from the ECB. The paper is a very good example of multiple high frequency data sets and a very interesting study on causal connection between futures and spot market activity. So Casper is coming from the ECB. Casper, the floor is yours.
Thank you. Just to make one thing clear, I'm from the Bundesbank. My co-author is from the ECB, but thanks anyway. This is joint work with... Exactly, still the disclaimer, my views are the usual thing. My co-author is Mark Hersflischer, he's currently at the ECB, and exactly, we use technical outages on trading venues in the government bond market, in the European government bond market, to track or see how the future and the cash market interplay. So we use these outages as natural experiments, and I'll show you why this is important. Well, the risk-free yield curve is key for all asset pricing. Every bank loan, every retail loan, every corporate bond is priced on the risk-free yield curve, and the risk-free yield curve is derived in the euro area from the European government market, government bond market. So the functioning of that market is of special interest to everyone. And there's already abundant literature on why these yields change. So we focused more on where the price formation takes place, on which venues, in which instruments. Are there any of these venues or instruments of systemic importance? And again, we exploit these technical outages, which are very sharp and sudden. They are unanticipated and exogenous shocks, so perfect to study how this market functions in normal times. And it's a pretty clear causality too. So it's a good type of experiment to look into the market. So just the results preview. We look at what happens when the future market is down. That's the Eurex market in the EGB, the European government bond market. And we find a very sharp impact on the cash market. The cash market suddenly stops working in many dimensions. So this is more than we anticipated. On the other hand, we don't find symmetric effects. So the cash market has very little to non-impact on the future market. And we also look at spillovers between US Treasury futures and the European government bond futures, and find no spillovers, which was also very surprising to us. But I'll dig into more details in the following. Just a quick overview of the European government bond market. The future market, which you find here on the left-hand side, is very homogeneous. You have a couple of futures per country, and only for 4 countries, the German, the Italian, the French, and the Spanish government bond markets. It's a very homogeneous market, centrally cleared on Eurex, just one venue. And we have full transparency and all the data available at hand, also in high frequency and real-time data. And the opposite is the case for the cash market. The cash market is very heterogeneous. We have almost 100 bonds per country of these 4 big countries we look at. It's on several different trading venues. You have several different trading protocols. And there's also very little transparency, so very difficult to look into that market. And it's also heterogeneous across countries. So that was one of the biggest difficulties for us, because these technical outages are only a couple of hours long. So in order to look at what happens on the other markets, we actually have to have high frequency intraday data, and also for a longer history, because some of these outages are older. And we have, luckily, a regulatory transaction level data set, which focuses to some extent on German bonds. So we complemented this data set with several data from high-frequency data, again, intraday from trading platforms such as MTS, which is a very large, or it's the interdealer platform for government bond trading, bond vision, etc. And that's just transaction level data, but to see not only what happens to transactions, but also to quoting activities from market makers that, try to facilitate liquidity in these markets. We also look at quoting activity from these market makers. So overall, this gives us a very clear picture of the cash market, even though it's so fragmented. First thing we want to look at is what happens during these Eurex outages. So again, Eurex is the only platform where government bond futures in the euro area are being traded. So we have two very recent, or rather recent outages, both in 2020, one in April and one in July, both of which were for 3 to 4 hours long, and both of which were due to faulty third-party software. So what happens on the cash market then is we divide this into trading volumes, what happens to trading volumes, what happens to liquidity provision from market makers, and what happens to prices if a trade occurs. And let's first look at trading activity. What you see here is the cumulative trading volume in billion euros in these markets, in all 4 countries aggregated, normalized to 0 at the start of the outage. The outage is highlighted by this gray area, and the outage day is the red line. The blue lines are comparative dates in the week ahead and the week before. And you can already see that the cumulative trading volume during the outage is like 2/3 lower than in regular times. And we have this presentation will be rather visually, but we also have regressions to check this more formally and have pretty clear signs that this is true. And we also check in these regressions that it happens to all countries and also in longer term bonds rather, because the uncertainty is higher in these bonds if the future market is down. So trading volume is down. Quoting activity from the market makers is also down. You see here the totally quoted volumes by these market makers on aggregate in the different countries. On the top is Germany, and you can see that especially for German bonds in the MTS market, there's almost no quoting activity whatsoever when the future market is down. You also see for France and Spain similar effects, and only Italy has to some extent some quoting activity left. And that's probably due, is our assumption, because Italy has rather strict primary dealer obligations for MTS especially. So these primary dealers in Italy are, by the Italian Debt Management Office, required to make certain quotes. So they keep quoting even in times of the missing future market. The German Debt Management Office does not have that. So that's the reason dealers would immediately stop trading in these bonds. Indicative quotes from other platforms that take a large share of the cash market. And I don't want to dig into details. These are yield quotes. They just flatline during the 3 to 4 hours. There's almost no price movement for 4 hours in the government bond markets, which is kind of more than we thought, because we thought market makers would still know to some extent what prices are, but without the future market, it does not look like it. So the third dimension we look at is if a trade occurs, what happens to pricing hours? For that, we fit a yield curve to the intraday outage windows for these days and the comparative dates, and calculate the spreads between the actual transactions and the fitted yield curve, so the pricing error. And it's several times higher during the outage than otherwise. I mean, you have sometimes 20 to 30 basis points spread for an 8-year transaction that is pretty expensive for one side of the transaction. We confirm this over time. These are the noise. This is a noise measure from Hu et al. It's by far the largest during these 2 outage days compared in this period, even larger than during the COVID crisis, which was an especially volatile time. And we have much higher noise here in this time. So what we're currently looking at is who actually makes these, or who participates in these ridiculous prices. I cannot give a clear picture on this yet. We're currently exploiting the non-anonymous data, transaction level data. We hope that this can be answered soon. This is just robustness. I skipped this. We have over 23 outages overall we checked, and they confirm these findings. So I go on to what happens when the cash venue is down. We have 2 outages, more recent ones, Bloomberg and MTS. Bloomberg is the largest trading platform for cash bonds in Bunds. And we find in short, no significant impact on the future market. Here on the right-hand side, trading volumes look similar to regular times, even though Bloomberg there's no trading activity whatsoever on Bloomberg. I skipped the next one. This is the outage of MTS, but there's also no effect. So the third part we looked at is, are there at least spillovers between the US and the EGB market? Because usually in literature, there's a very close connection between these 2 markets. So you would expect that an outage in the one market has an impact on the other market. So we don't find anything in that case either. This is the Eurex outage in 2020, the 2 of them. Just a small drop on the left-hand side, but other than that, no large impact on quoting activity in the US Treasury market. And the other way around is probably where you would expect an impact. So when the US Treasury future has an outage, this is in 2019 on the left-hand side for US Treasuries, you would expect something to see in the Bund future market, but we don't see anything. This is a very early morning in the Bund future market, but we have robustness checks outages, and they confirm these findings. So to conclude, the bond future is key. The bond future market in the euro area is the key to all market functioning in the EGB market. Without it, you don't have any price signals that cash bond traders can look at. And the cash market itself does not generate significant price formation. We also have because of that, we have no symmetric outage effect. And we also don't have spillovers between US Treasuries and euro area bond futures. So other than we thought previously, liquidity provision is pretty domestically. How does that contribute to literature? Well, for one, many theories are on cross-market arbitrage, but they would imply symmetric outage effects, so that the cash market actually also impacts the future market. Our findings are more in line with models based on cross-asset learning. So the key idea here is that a very informative asset is used to price and provide liquidity in other assets. And this is the case here. The very informative, very important asset is the bond future. And this also feeds into the dominant versus satellite market discussion, which is usually based on stocks. And they say one stock, several trading facilities or trading venues. There's always one primary exchange where price discovery takes place and has effect on the other stock venues. And in this case, for the fixed income market, the very, very dominant market is the future market. And finally, what are implications for policymakers? Where the future market is very homogeneous and thus plays a central role in price discovery, but an outage is actually a systemic risk because it's the only or one of the only hedging instruments, for example, for interest rate risk management. And we don't find any alternatives in our analysis. Cash market, on the other hand, is very heterogeneous. So if it plays a minor role, because of that, a minor role in price discovery, but is robust to individual outages. This findings can play into the discussion on, for example, central clearing and all-to-all trading, which is currently occurring in the US. Duffy and the US SEC had proposals on that. This could improve the price discovery on the cash market, and also into the idea from John Cochrane in 2015 to have just 2 bonds instead of 100 per country, both of which are perpetual. It's a exotic idea, but it would improve the liquidity on cash markets. So overall, maybe just another one, because that's the theme of the workshop for interest rate risk management. The future market, when it was down, also the alternative for hedging, the swap market, was also down in the longer term. So it's actually quite essential for the interest rate risk management to have this market, and the substitute market was not found without the future market. So many thanks.
Many thanks, Casper. So now, as a virtual discussant, we have Samuel Rosen from Fox School of Business, Temple University. Samuel joined Temple University as assistant professor in 2018 after receiving his PhD in finance from the University of North Carolina. And prior to this, he was in the Financial Stability Division at the Federal Reserve Board. Samuel, the floor is yours.
All right, well, thank you for that introduction, and thank you also for having me here to discuss this very interesting paper. So let me just dive right in. So yeah, I like to start off discussions, I think, really just distilling a paper down to its core essence. What am I going to remember 6 months from now, and what should you remember? And I think really, empirically, just directly, they show that when the futures market, there's an outage in the futures market for European sovereign bonds, that causes the spot market to seize up. Now, of course, they have more results than that, but big picture, that's one of the main things that they show right off the bat. And this contribution, because this shows this causal, this I guess crucial nature of the future market activity in order for spot market activity to commence. And so I think that's kind of really big picture what they show. Now, I think there's a ton to like about this paper. They have this really clear and simple natural experiment that they're able to take advantage of. They have great data. The paper is super well written. I'm not a microstructure guy, and I don't know these markets. I didn't know them before reading this, and I think I was able to really understand the key institutional aspects, and even the presentation I thought really fantastic in terms of just clearly portraying the results. I think these are interesting findings, right? There's this causal connection, but there's also the fact that it's not the other way around, where if the spot market itself has some sort of outage or interruption, that actually doesn't flow the other way. And that's kind of, I think, where the more theoretical contribution plays, is kind of showing that this asymmetry there. Now, of course, this is a discussion, so now I'm going to proceed to maybe some comments and maybe pushing back on the authors a little bit in certain ways. So let's kind of shift towards that. So first, in terms of why should we care about these results? Why do they matter? I took a few quotes from the paper here. They start off saying that they're asking where and how price formation takes place, and they say the results tell us about how the bond market works in normal times. That bond futures are necessary for the market to function smoothly. And then they also have some comments about, this tells us a little bit about maybe the cyber risks, and also this systemic importance angle, which, I had, as you mentioned before, I come from a financial stability background. So, of course, I appreciate and want to think through this side as well. But, particularly these last few points, there's this implicit assumption that these outages also had a negative impact, right, in a welfare sense. People were harmed, or this was a bad event that caused problems. And so now that's kind of what I want to maybe push back a little bit on, or at least kind of think through what exactly that means. So, first off, who was actually harmed by this outage, right? If this was a bad event, or this, caused harm to people, who was it, right? And we know for sure that spot market trading, basically evaporated, right? The authors show that very clearly, the causal nature, right? It's very, very clear from the results. Right, but if no one's trading, who is actually harmed, right? And I think there's, roughly two groups of people who you could argue were harmed by this outage. One is there's people who wanted to trade during that window and couldn't, right? So they had to wait either to trade in the futures market or assuming that they wanted to trade in the spot market, but they saw it wasn't functioning and couldn't, right? So there's people who had to delay their trading. And if someone had an immediate liquidity need, right, that person really was harmed. But then there's also the people who got a bad price where they show, that's another part of the results, is that the people who did trade, the pricing errors were large. So I think, if the authors do want to imply that these were kind of negative events, I think it puts we need to think a little bit about, how big are these groups? And the fact that there's so few trading means that maybe the second group ultimately isn't that big. But if we want to have some sort of implication that this was a bad event, I think there should be some thought there. So next, the kind of maybe one thing that the authors, necessarily can't say for sure is, well, why did trading stop in spot markets? And their hypothesis is essentially that, all right, it must be that futures markets prices are vital inputs for the spot market, right? And the fact that the futures market was broken means that the spot market traders just didn't know how to price bonds and couldn't trade. And I think, there's an alternative story, which maybe isn't that different, that says, what if the traders just, they saw the Eurex was down and they just said, all right, let's take a few hours off, right? And I think really the kind of key difference between the first and the second is just, were traders unable to trade, or did they just choose not to because maybe just part of their trading strategy involved simultaneous trading? And I think this is a little bit related to the welfare angle of just, were they actually prevented from trading, or is this just, oh, it's out for a few hours, we'll wait till it comes back on? And I think part of this, which I guess the authors do have some insight into, and even mentioned that they're looking into, is how much do these traders groups overlap, and if they really were kind of simultaneously trading in both markets, maybe it's a less negative outcome that, oh, we just didn't trade for a few hours, right? And one thing I thought the authors could do, which I know this doesn't qualify as a rigorous analysis, but I wonder if you did talk to the spot market traders during this time period, why did they stop trading? I think they may be able to kind of tell you, or at least point to one of these hypotheses over another, and also maybe speak to this idea of if people were harmed. So, what to do moving forward? Well, one thing that jumps out too is that, okay, maybe these outages, they're sporadic, maybe they're not that long. And, big picture question, right, from the systemic risk angle is, should we ultimately be worried about these types of events where, the authors actually, part of their evidence showing that there's not this spillover to U.S. markets make us think, well, maybe we shouldn't, right? Even though you have these correlated asset groups, an outage in one market doesn't actually seem to spill over and create problems in an unrelated but different setting. But then there's also an argument that maybe, yes, we should be concerned because perhaps these few instances were a couple hours of downtime. But what if these events were longer? What if the Eurex was down for a few days, right? Then would that really start to cause a lot more trouble? And I think that feeds into some of my earlier comments. So final thought, I really think this is a cool paper. I like, the conclusions, the results. And I think that to me, the coolest part is just how they use this event and really, reveal this hidden plumbing going on behind this market. And in terms of their first question they asked, they really do tell us, where the price formation takes place and the crucial aspect of that market. But in terms of where the contribution lies, I think it's a little less clear if they tell us how the price formation takes place. And also, I think the concerns about systemic risk is at least at this point maybe not as clear to me as well. So that's my discussion. Thank you very much for your time. And once again, it's a great paper and really enjoyed reading it.
Many thanks, Samuel. So let's see if we have any more questions from the audience here. There is one question here in front. In the meantime, also the virtual audience can provide the questions via chat.
Thank you. So you can hear me, right? So I guess my half comment, half question, right? So why don't you trade cash bonds when the future markets breaks down? Typical reason would be that you can't hedge your market making book, right? So I guess my question to you is, as you dig into the non-anonymous data, it might be worthwhile as a question to see how much of this is the banks or the market makers that stop trading simply because they can't then cover their their positions, long and short, whatever they are, right? So I think there's in the identities of the non-traders might be a hidden truth, right? So when you talk to the so-called spot traders, I think that's a nice way of saying market makers as well, right? So I wonder from a risk, sort of systemic risk, why should I worry perspective, if it's all the largest commercial banks that have a market making operation, I would argue that's good risk management, right? Thank you very much for not taking bets you can't hedge, so that's okay. If it's other people and there's something else going on that they are some other reason, then we might have a problem. But if it's the banks, then sitting at the EBA at least, then I'm grateful that they stop trading until they can cover their bets, right, so to speak, so that they stop being in trouble. Yeah. So I think there's this duality to the question here. Yeah.
Any other question before we move to the answers part? Okay, so can you ask?
All right. So thanks, Samuel, for the very interesting discussion. I mean, many of the points you asked yourself, we also asked ourselves. Maybe just as a first start, why we are not putting such a focus on welfare risks was the initial start of the project was not to see if that's a systemic risk. I'm from a markets department. I'm not from financial stability. For us, it was primarily of interest where actually, when we look at yields, which market is the market to look at. And we now have a pretty clear answer to that. It's the future market. But you're right. This is also an interesting dimension to look into. And I think you answered the question to some extent yourself, because you said these outages could be longer. I mean, these were technical outages, 3 to 4 hours, not a big deal. Traders maybe said, yeah, I'll just wait this out. We know it's a technical issue, but in case of a cyber attack or similar things, it could be a couple of days or a week. And in that case, it appears that from the fixed income market, there's no clear signal as to what fair yields are. And in a longer period, this could have quite significant impact on bank operations. So I think that's, right now, the welfare impact is not large in these outages. They will occur again. We just use them as a natural experiment. But if they are longer, that's a big risk. Yeah. Well, the idea to ask spot traders is also a good one. We did talk to spot traders. We have regular exchange with them. And the picture we received was that they actually primarily derive prices from futures. So it is that price formation takes place on this market. And from what we learned is that they usually use the interest rate swap market also for hedging. So that could have been an alternative if hedging was the issue, but they don't in that case, because the interest rate swap market also derives its prices from the future market. So I think that covers that. Overall, I think both suggestions were very good in regards to what's the overlap between future and cash traders, and that's what we will look into once we exploit this anonymous data. We hope that we can find something there, but it's not so far. We find no clear picture. We looked into it very granularly and also in the more macro picture, but it appears that everyone equally reduced their trading. So banks did just like investment funds did, and etc. So I think that covered all questions. So again, thanks for the ideas, and